Generally speaking, I'm very bullish on REITs, and these are not empty words, as I have about 50% of my portfolio invested in them. I'm so bullish on REITs because valuations are some of the lowest they've been in many years, balance sheets are the strongest they've ever been, rents keep growing at a solid pace in most property sectors because of the high inflation, REIT management teams as well as private equity players like Blackstone are buying REITs left and right, and then finally, REIT dividend yields are today really high even for high quality REITs. In some cases you get yields as high as 8%, and then on top of that you get to buy real estate through REITs at a large discount to its fair value. But that does not mean that I'm bullish on every REIT. In fact, we actually only invest in about 1 out of 10 REITs on average at our REIT newsletter High Yield Landlord. We are so selective because some REITs are over leveraged, some others are poorly managed, some invest in struggling property sectors, some are getting too big, some are overpriced, and so it's very important to be selective. And today's video I want to highlight 2 popular REITs to you that we recently analyzed and decided to not buy because we think that there are better opportunities out there. But before I get into it, if you could please like this video, help me a lot. Thank you very much. So the first REIT I want to highlight here is called ExtraSpace Storage. This is one of the leading storage REITs in the US. It was in a lot of headlines recently because it announced that it would acquire one of its close peers called Life Storage. But I'm not a big fan of this deal. I'm sure there are some synergies, but I think that they are overpaying for it. Less than 6 months ago, Life Storage was still trading at about $94 per share. Then came out Public Storage, which is another storage REIT, and it offered to buy out Life Storage for $129 per share. Life Storage refused this deal, and then came out ExtraSpace and it made its own offer for $145 per share, another large premium to what Public Storage was paying, and I think that we are paying too much in this case because this represents a near 50% premium to what it was trading for less than 6 months ago. And another red flag here is that Public Storage is the largest in this sector, it has the lowest cost of capital, and it wasn't willing to pay more than $129, yet ExtraSpace is paying a lot more than that at $145. So that tells me that ExtraSpace probably paid a bit too much for this deal to occur. Now they're gonna become the largest storage REIT in the US, which will likely justify higher salaries for them. Maybe that's part of the reason why they were so happy to make this deal happen, but I think that this will not help shareholders in the long run because yes, size has some advantages, you get economies of scale, we've discussed this previously with some other REITs like Realty Income, but the downside now is that ExtraSpace will now have a near $50 billion value, and so this means that we'll have to find a lot of new investment opportunities to keep on growing. But how many are there really left? Today there is already about 10 times more storage space per capita in the US than in the UK. It feels that there is a new storage property being built in every busy intersection of the country, and so I fear that there simply won't be enough supply in the US for ExtraSpace to keep growing at a rapid pace. At the same time, I fear that the demand for storage space is going to cool off in the coming years as we come off the pandemic. The pandemic greatly benefited storage space because people were moving around, they wanted to make space for a home office, and some of the older generation passed away, left a lot of stuff behind. But now as things continue to normalize, I think that we're gonna see the demand come down a bit because people are not moving as much anymore, people are not using their home office as much anymore as they return to the office. Now the vaccine is also preventing people from dying as much from COVID, and so overall I fear that supply is coming down just as supply is going up because a lot of properties are still under construction, and so this could hurt the organic growth prospects of ExtraSpace going forward. And on top of that, as I mentioned earlier, its external growth prospects also aren't looking as promising anymore now that it's so big, and so when you put all of this together today at 18 times FFO, I don't think that's particularly compelling. Then the second REIT I want to highlight here is Tanger Factory Outlet. They just recently released their first quarter results. Their share price surged as a result of them because they beat expectations, they hiked their guidance, the traffic at their outlet centers is recovering nicely, they're signing new leases with large positive spreads, and the market really liked that. But it's hard for me to see the opportunity here. As a result of the recent surge in its share price, Tanger is today roughly flat over the past year, even as the rest of the REIT sector has dropped by about 30%. I think that part of this outperformance is probably justified because the company is nicely recovering from the pandemic, but then some other part of it really isn't. I think that the market has gotten overly excited about the near-term growth prospects of the REIT. Its fundamentals are today really strong as it keeps emerging from the pandemic, but I think that the market is forgetting about the long-term outlook, which I think is quite negative. I fear that outlets will be the retail format that will suffer the most in the long run from the growth of e-commerce and also the growth of other retail concepts like TJ Maxx. I think that this is the case because of two main reasons. The first one is the location of these properties, and the second one is their layout. Typically, outlet centers are located a bit outside of big cities where land is cheap and abundant, so people have to drive to get there. So far, people are willing to drive there because they were promised to get better prices. But now today, prices are comparable or even better on Amazon, and so the drive is getting longer and longer, I think, for people. At the same time, TJ Maxx is building more convenient retail locations closer to people, and so now the incentive of making that long drive to get to the outlet is also lower than previously. Then the second issue is the layout. Typically, outlets are really built for fashion and accessories, so they cannot as easily now start to diversify their uses to pull more traffic in other ways. I think that Class A malls, on the other hand, are much better positioned because they typically have much better locations in urban centers with strong demographics. The layout's also more flexible, so they can include mixed uses like a lot of restaurants, entertainment and services, other things that you cannot easily get online or elsewhere. Despite that, Class A mall REIT Simon Property Group is today actually priced at a lower valuation than Tanger Factory Outlet, and so it's hard for me to justify paying up to buy outlet centers, which I think will face a lot more difficulties in the long run, when I could just buy shares of Simon Property Group, which in my opinion owns better assets at a lower price. I actually own a position in Simon Property Group. I think it's very attractive today. It also just posted strong results for its first quarter. If you want to learn more about what else I'm buying at the moment, feel free to join my REIT newsletter for a 2-week free trial. I'll put a link somewhere in the description of this video. And again, otherwise, if you could still like and subscribe, that will help me a lot. I will appreciate it. Thank you very much. Bye bye.